So what's driving this rotation? Two things. People seem to believe we could see some progress in the trade negotiations with China. Personally, I'm skeptical. More on that later, but hope spring is eternal. And on top of that, there's a belief that the Federal Reserve has no choice but to cut interest rates after Friday's not-so-hot unemployment number. Once rates are cut, the bulls wish that the economy will get stronger, which is why the long-term bond yields surged today. Also, it might explain that rally in oil, although that could just easily be because the Saudis might cut back. And when money managers see a rally in oil, they assume the economy's improving. So they buy the retailers, the down-and-out retailers, not just the watch retailers, as if higher gas prices somehow bring in more shoppers. But since I'm no longer running a hedge fund, I'd like to be contrarian at this moment. You don't need to chase these rotations because you don't have rich investors breathing down your neck, pushing you constantly for outperformance on a daily basis. You can afford to buy what the money managers are selling, although I wouldn't sell what they're buying because those stocks are way too cheap to ignore. We're still not yet at a level that can necessarily sustain a real bottom in the turbocharged growth stocks. Some people are just beginning to realize the sell-off started. But remember, if long-term Treasury yields keep climbing, the presumption will be that the economy is doing better. And in a better economy, investors abandon these secular high-powered growth stocks for the cyclicals, the oils, the banks, and the old tech stocks, like what they bought today. I think it's wrong. The truth is high growth never really goes out of style for long. It just has periodic hiccups that shake out the weak-handed shareholders. That's what's happening. So if you haven't already found a terrific cloud stock you want to buy into weakness slowly, please, maybe you want to think about Cramer fave Salesforce, just reported a great quarter, or Okta, which is cratered despite its dominant position in the high end of cybersecurity. Or maybe you want to listen to one of the two companies I have on tonight that are high growth and think that you get comfortable with one of those. The bottom line, you want to know why your growth stocks are getting annihilated, right? It's because there's a market-wide rotation out of these companies. Hey, by the way, that is exactly why we play MI Diversified. So that on days like today, you won't have all of your eggs in one high-flying and now yolk-filled basket.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.